The spreadsheet has been active for 11 hours. The model is expected to perform reliably. You work at a local firm in Oslo. The figure is 4.2 billion. Your identity remains unknown. This evening, you subject the fixed income section to a 150 basis point rate shock stress test. You have carried out this precise assessment 47 times. This is your 48th attempt. At 11:48 p.m., it fails. Something is significantly amiss. The mistake isn't yours. A senior manager named Erickson bypassed a duration constraint. He concealed it within a cell that appeared to show zero. Hidden for 3 weeks, 340 million in notional, leveraged exposure to long-dated Norwegian krone debt. The swaps were designed to maintain flat volatility indefinitely. The hedge was merely a facade, utterly ineffective. Then the Norges Bank releases an unexpected statement indicating an aggressive interest rate increase. The mark-to-market loss escalates to 61 million and continues to fluctuate. Sleep evades you. You open a new spreadsheet and create a second model. This new model corroborates the initial results. You develop a third. All three models agree. At 2:15 a.m., you formulate an encrypted message for your compliance officer. Without hesitating, you hit send. The message is dispatched. By 7 a.m., compliance has escalated the matter directly to the board of directors. A shift occurs in the office. By noon, external auditors arrive, requesting files for which no one was prepared. Erickson is placed on administrative leave. No one on the floor makes eye contact. The position unwinds with a 47 million loss instead of 61. The market moved in your favor. What stands out is that you discovered it. You sent the message at 2:15. 3 weeks go by, Erickson is gone. You return to your desk, and then your phone rings. The caller is Johan Vesterås, a man who has never worked for a small organization. He represents the government's petroleum fund, managing 1.4 trillion. It holds 1.5% of every publicly traded company on the planet. He mentions an opening in quantitative risk, conveying it casually. He suggests you think it over during the weekend. This conveys everything you need to know. You start on a Monday in January, entering a new building bearing a new badge and entirely different numbers. Your badge identifies you as an analyst in quantitative risk. For 8 months, this is precisely your role. You construct factor models and decompose portfolio variance. You don't alter the controls. Decisions worth 800 million are made as casually as selecting lunch. The numbers still seem unreal. 800 million resembles someone else's dilemma. What changes your perspective first isn't the magnitude of the funds involved, it's the patience of this institution. This fund absorbs market shifts. It does not react to earnings misses or analyst downgrades. It simply holds. The fund's size means that panic selling could unsettle the market. Here, panic simply does not exist. You begin to understand what true capital permanence looks like. Fear is systematically removed from the equation. 8 months in, you are still an analyst, yet you are grasping the operation. Your understanding evolves slowly and then suddenly, in the manner typical of learning what truly matters. It's not a lack of fear that sets this place apart. Fear never had a foundation here. Markets open and close, crises arise and resolve. The fund does not flinch. You remain an analyst, but your perception of money has irrevocably transformed. By the third year, you are no longer just an analyst. Your title shifts, and so does everything else. You find yourself present when allocations are made, not at the table, but rather in the room. You witness how decisions are formed. It bears no resemblance to what you learned in graduate school. It's political. Each number carries relationships behind it, and each relationship has a story. The head of equity, Pai Lottie, a Finnish woman, oversees 620 billion. She navigates her position with academic rigor and an unwavering disposition to challenge her superiors. Independently, she eliminated a 2.1 billion infrastructure allocation in merely 40 seconds. And nobody contested her. The counterparty model was crafted by a consultant who once demolished a Dutch pension fund in 2019. Pai remembers everything, the failures in every model dating back farther than anyone else in that room. You commence building your own archive, indexing every deal, consultant, and risk model in 3 notebooks within 3 months. retaining every observation and everything the institution overlooked. After 6 months in that space, you evolve into a fundamentally distinct type of analyst. You painstakingly cross-reference 7 years of fund records, uncovering patterns no one previously cataloged. Names that had been forgotten resurface in your archive. The patterns solidify. Then one day, Pi directly poses a question to you, with the entire room watching. You respond from memory, drawing from the archive and the notes you took on your own initiative. Pi nods once before returning to her documents. In this context, one nod holds immense significance. From that moment onward, the room feels transformed. The table you're not yet seated at appears closer. You remember everything after this point, the fund, the names, the history, all of it becomes yours. As the 5th year wraps up, you transition to a portfolio strategist for real assets. You're no longer an outsider looking in. The real asset sleeve is valued at $74 billion, encompassing infrastructure, real estate, timberland, and unlisted equity. These are not simply trades in the conventional sense. You're acquiring structural positions. You secure a 40% equity stake in a Chilean desalination consortium dedicated to water infrastructure. You establish a ground lease for the Rotterdam Port Logistics Complex, a commitment spanning decades. You become a cornerstone investor in a renewable energy initiative in Kenya, a stake projected to represent 18% of the national grid by 2031. While you expected to feel powerful, what you actually feel is the weight of responsibility. This sensation is novel. Holding power at such a scale does not equate to feeling powerful. It translates to an enduring obligation. On a Sunday morning, the Chilean consortium opts to raise water prices. An NGO publishes a report connecting this increase to foreign ownership. You absorb every detail. Back at your desk, you analyze the reputational risk, then the regulatory risk, followed by the replacement cost, which amounts to $2.3 billion. This figure becomes the decisive element. You propose a $14 million community investment initiative, which the fund greenlights. This isn't idealism, it's a measure of risk management. You find yourself questioning which is more genuine. The ideology you arrived with has evolved into a refined calibration, quieter, more enduring. Every position you oversee impacts people, many of whom will never learn your name. You manage $74 billion with the same discipline formerly applied to $4.2 billion. The scale may differ, yet the fundamental question remains. What is the real risk involved? As the 5th year concludes, you find yourself at the table, intricately woven into every system you engage with. In the 8th year, the call originates not from within the fund, but from the ministry. Minister Solberg extends an offer for the Deputy Chief Investment Officer position, presenting it in the form of a question. But it isn't one. You accept, fully aware that restful sleep will become a luxury you can never reclaim. This too is a certainty. The Chief Investment Officer is a man named Thorvald, a rare presence at such a high level. You analyze him as you once dissected spreadsheets, identifying patterns, tolerances, and blind spots. At this strata of capital, movement occurs through relationships rather than mere market fluctuations. This constitutes your first lesson. You find yourself across the table from a global bank's chief financial officer, engaged in restructuring $90 billion in Tier 1 capital. You secure board observer rights, demand fee transparency, and establish the most stringent ESG covenant ever included in such an agreement. Their stock surges by 4%, based on rumors of anchor investors before any public statements are made. You manage the liquidity framework of $1.4 trillion. Every assumption, each correlation, and every scenario. See Thorvald making decisions that you can't yet fully comprehend. You record his moves, intending to make sense of them later. Sleep transforms into a resource you manage. Scheduled similarly to currency hedges, your personal calls diminish, and your marriage reduces to logistical coordination. At this level, you are acutely aware of both. The personal sacrifices become less incidental and more intrinsic. You accept this implicitly. You sign off on a $2.2 billion allocation within 5 minutes. $1 billion has now become a mere unit of measurement. The scale no longer feels abstract. This transition proves to be the most perilous of all. You become attuned to Thorvald's decision-making pace, how long it takes him to act, and what prompts him to hesitate. You're no longer observing the machine, now you're operating it. At this level, power and responsibility merge into a singular entity. The 8th year reaches its conclusion. Thorvald confides a secret he's never shared with anyone else in the building. He gives 18 months' notice. No one outside this floor will be informed for 6 months. The list of external candidates grows extensive. You watch as names get eliminated one by one. Confirmation comes in a 4-minute call from Minister Solberg. In those 4 minutes, you become the chief investment officer, wielding oversight over more capital than most countries' GDPs. You are 41 years old, and your personal phone displays 12 missed calls. Power does not surface as a form of liberation. Rather, it represents a contraction of possibilities. Every conference appearance, every public letter, and every vote at an annual general meeting is scrutinized on a global level. You stop attending conferences. The signals you send forward alter the dynamics of your position. Not appearing acts as its own signal. You train yourself to differentiate between thoughtful consideration and indecision. Internally, they may feel indistinguishable. The network that elevated you to chief investment officer tightens the moment you take on that role. It follows the same pattern. The individuals who can communicate with you openly are fewer than 20, and that number continues to dwindle. You approve a $2.2 billion allocation without a moment's hesitation. For you, a billion has become just a unit of measure. The markets respond. Cautionary indications pop up on your dashboard, yet you remain calm. Every action you take is scrutinized by officials, competitors, and markets that have already assessed your value. The chair does not guarantee your permanency. It merely makes your actions visible. Those two things are not synonymous. Your marriage now revolves around logistics and scheduling, an understanding shared silently between you both. The false sense of control over the market begins to develop, only to be corrected by the market itself. You realize that the market has never cared about who occupies your position. Year 1 as Chief Investment Officer concludes without any disaster, which is an accomplishment in itself. As you enter your 2nd year, a G20 nation finds itself in a sovereign debt crisis, illiquid but not bankrupt. The market has already factored in a potential default. The International Monetary Fund package is 12 weeks from ratification. You possess $18 billion in cash reserves from a rebalancing that Thorvald consented to reluctantly. This rebalancing was approved 6 months earlier, leaving the $18 billion unused. No one felt at ease with this decision. You analyze the scenario over 4 days, and every model confirms the same outcome. The nation is illiquid, but not bankrupt. That distinction carries a potential value of $6.2 billion. You allocate $2.1 billion in the first tranche of sovereign bonds for a country that the market has largely dismissed over 11 trading days. 3 tranches totaling $6.2 billion. This amount isn't sufficient to save the nation, but serves to indicate that permanent capital can recognize value in places where the market perceives failure. Other institutional investors take note and follow your lead. You remain silent while the position speaks volumes. The IMF package is secured under more favorable terms, and the nation avoids a default. Yields shift in your favor, bringing the position to an unrealized gain of $1.1 billion. 14 months pass with no public statements or press releases about your actions. Acknowledging the success would entail admitting what you accomplished, prompting a mandatory disclosure filing that triggers a legal examination from the Ministry Council. It's expected that this can be handled within parameters, but requires parliamentary review. The term technically does the heavy lifting here. This review will be structural rather than punitive. The central query revolves around whether the current regulations remain adequate. The legal advice arrives with confirmation of the need for intervention within existing mandates, but also calls for parliamentary scrutiny. The next chief investment officer will function within a more restricted framework. You have inadvertently established this by illustrating what was achievable, and in doing so, have made it permanently more challenging. That realization becomes your reckoning as year 2 closes and your position endures. The review is set to commence, and the rules are on the verge of transformation. You peruse the legal document on a Tuesday evening. Parliamentary review looms ahead, once again structural, not punitive. You set it aside. The markets in Tokyo will open in just 4 hours. Life across the globe continues without pause. $1.4 trillion with 9,228 companies in 73 nations ready to start trading the next day. The liquidity framework does not expect a single event to necessitate simultaneous liquidation across 4 asset classes. This assumption has stood for 19 years, but you question its permanence. The quantitative analysis team highlights a breakdown in correlation from the real asset sleeve as of 2017, a pattern that feels familiar to you like a previous spreadsheet from Oslo. You find yourself at 11:48 at night, contemplating a smaller life. The scale has shifted, altering everything except for the fundamental nature of the risk, which remains unchanged. You initiate a new analysis window, retracing the steps you typically follow in model construction. Below you, a junior analyst is conducting a stress test that won't be resolved until morning. You haven't learned her name just yet, and she is unaware of your existence in any significant manner. The fund will outlast both of you. It existed long before either of you arrived. The capital is permanent, but the people are not. A constant rule. The correlation flag remains open, and the model is incomplete, left unresolved until morning. Somewhere in the world, another crisis is brewing, and it will catch you off guard. A fellow operator is rising within this very building, undergoing the same process. You hold power, however, you do not possess safety. The parliamentary review is set to begin in 3 weeks. The cycle continues as each resolution brings forth the next challenge. The markets will open tomorrow, indifferent to the foundation you've built, patient as geology, waiting to reveal what you have yet to comprehend. Tomorrow, you will return to your seat and begin anew. For those seeking financial insights and updates, more details can be found in the description below. As we wrap up today's discussion, don't forget to subscribe to Billy Finance for more content like this. Thank you for being here, and I encourage you to leave your thoughts in the comments.